Hello, Market Insights watchers. Well, we hope your week is off to a great start. In Market Roundup, is history repeating itself? Historical data shows from the stock market that the first 2 weeks in July are positive for the market. So is this trend holding up? And in tech megatrends, see which historical industry is about to get an AI makeover. And in Crypto Corner, hear what Ian has to say regarding Bitcoin and crypto sell off and what that means for future investment ideas. And of course, while you're here, please like and subscribe to this channel here on the Banyan Hill YouTube channel. So let's get started. Well, hello there, Ian. I see you're in a new location. What's going on?
Just taking a little family vacation, kind of working remotely, visiting some family and friends.
Oh, I'm glad that you're having a good time. It looks like a lovely setting. So glad you're there. Okay, everyone. So in Market Roundup, Ian, I posted this chart on X on June 6th with the headline, Attention Stock Bulls, History Repeating Itself? Per Bloomberg data, going back to 1928, the first 15 days of July are the best 2-week trading period of the year for stocks. I'll quote, the S&P 500 index has been positive for 9 straight Julys, posting an average return of 3.7%. So we are now halfway through that time frame, and thus far, the S&P is up 1.7%. Let's see if these gains continue, especially with signs that mounting that the economy is seeing some slowing from the latest jobs report from last week, hence the potential for a Fed rate cut increasing. Everyone, this week we have a major economic data release for June CPI inflation on Thursday, June 11th. Economists are expecting a soft inflation print, which may help give the Fed confidence to start cutting rates by as early as September FOMC meeting. Also this week, Fed Chair Jerome Powell will provide his semi-annual monetary policy report to the Senate Banking Committee, and it's expected for Powell that he will strike a more dovish tone overall there, really IDing progress made thus far in harnessing inflation. So that's what we can look forward to this week, Ian, in Market Roundup.
Lots of stuff.
All kind of good stuff there. Okay, everyone. So let's move to tech megatrends. The U.S. artificial intelligence, I can say it's just prolific across a variety of industries. Now AI is set to actually transform an industry that dates back at least 43,000 years. And I'm speaking of the mineral mining industry. So today, AI usage in mineral mining is growing. In fact, per market.us data, the global AI mining market is expected to experience substantial growth, reaching an estimated value of nearly $7.3 billion over the next 9 years. This growth is driven by a robust compound annual growth rate of 22.7% from 2024 to 2023. So, Ian, I'm not sure if you're a watcher of the Discovery Channel, you and your family, I'm not sure. But there's one TV show that I enjoy watching on that network, and it's called Hoffman Family Gold. And it focuses on a multi-generational family as they mine for gold in Alaska. And in the recent episode, the son used a drone with LiDAR technology to scan the terrain for the best prospects for gold mining. And it was actually quite interesting to watch. Well, I can say that the Hoffman family of gold hunters is actually on the money because a new report released by Bloomberg government today, as we record this July 8th, reveals that U.S. federal officials are, quote, banking on an artificial intelligence project among the Defense, Energy, and Interior departments to actually help the government and mining companies locate critical minerals more precisely for faster extraction in the U.S. The advanced research arms of defense and energy, along with U.S. Geological Survey, have really teamed up with universities and tech companies on hackathons to use AI to map critical mineral resources across the country. The group completed its most recent hackathon, its third in late spring, and has another scheduled in the next few months, end quote. So, Ian, I was thinking that this is actually quite very promising news because, as we are all aware, many minerals that are used in a variety of items that we purchase, from cell phones to even EV batteries, are likely
And everything.
Everything, yeah, hello, are imported from countries that really just have uncertain human rights and environmental records. That's why of course, we had that very true bipartisan effort manifested back in 2021, the bipartisan infrastructure law, which is actually had parts of it focused on reinvigorating the U.S. Geological Survey critical minerals resource program, which includes the mapping over the 10 years in mining as an inflection point. But anyway, I like to just conclude that major mining companies are already seeing results from using artificial intelligence. For example, Newmont Corp has reported a 15% increase in productivity at its Nevada gold mines. This growth is primarily attributed to the adoption of AI-powered drill pattern optimization type software. With that being said, I was thinking, how can we as investors partake in the potential growth in the AI mineral mining market? And there's one company, of course, it's an ADR, but it's Infosys. Now, Infosys, it trades on the New York Stock Exchange under the ADR ticker INFY, and it provides AI-driven solutions and consulting services tailored to the mining sector. And it's partners partners with mining enterprises in AI, leveraging AI, machine learning, and cognitive computing, really to determine where and when and how to mine the most efficiently. So I just thought that was an excellent idea of marriage of AI and mineral mining and how it's taking it to the next level after 43,000 years of existence.
Yeah, I love it.
Yeah.
And also, I think the bigger picture here is from the macro perspective is if you think about where the world has been and where it's heading,
Mm-hmm.
uh, since the late 80s, early 90s, we've had this period of great globalization. And
Mm-hmm.
that's caused inflation to basically remain low because we've offshored a lot of the production into other areas of the world.
Right.
Think about all the factories that were built in China in the 2000s and 2010s. But the last 10 years, the rest of the world has been worried about the rise of China. And
Mm-hmm.
because of that, you're seeing a lot of nationalist and populist movements around the world that are trying to bring production back to their home countries. Case in point here in the United States, where you've seen the absolutely, incredible growth in spending in U.S. manufacturing in the last couple of years.
True.
Uh, Turned in point by different legislation that was passed by the offices. But what happens is when you start producing your own goods and there's this big shift from cheap labor costs elsewhere to try doing it in the United States or in Europe, the price of producing starts to rise, and that becomes a structural inflation problem.
Mm-hmm.
Now, I think the biggest dynamic from a macro perspective in the next 10 years is the idea that we're starting to onshore. There's kind of deglobalization happening.
Mm-hmm.
At the same time, you're seeing the rise of technology allowing us to do more with less. And
Mm-hmm.
so the example that you've given of basically AI detected areas where they can mine for new minerals is going to help us produce those type of uh, elements in the United States, whereas we used to get them from China or South Africa, or other parts of the world cheaply. But doing it here, it's going to be more expensive. That's why we need to employ more technology to do it. So I think there's just going to be this great struggle between the onshoring of production of assets back to home countries, rising structural inflation, but that being offset by more technology. And I do think that technology is going to win just because of the way that it grows in an exponential, not linear fashion.
Mm-hmm.
And that's why I think, this decade is going to be extremely productive for the United States. And, you're going to start to see after, I think we're going to have a slowdown right here, but then the Fed's going to cut rates. You're going to see 5% growth rates, similar to what we saw in the mid to late 90s. Because of the internet, we'll have a similar wave of productivity growth and GDP growth, just like we saw around the internet. But this time it's going to be focused on new use cases for AI, just as you mentioned.
Wow, I love that. Exponential growth, that's what AI can do for us. Okay, Ian, so what's happening in crypto? All ears on Bitcoin.
Yeah, it's been a pretty eventful week. So, the markets have pulled back. I think Bitcoin's probably down 7-8% on the week. Same with Ethereum. We've seen a bounce the last 24 hours. What's been happening is that there was this exchange called Mt. Gox. And Mt. Gox had a massive hack in 2014. And Mt. Gox was like, they had something like 20% of the world's Bitcoin on this exchange at the time. And a lot of the assets were stolen. In the last 6-7 years, governments around the world have been able to recover those assets. They've seized those assets. And now, to pay back Mt. Gox's creditors, the governments are starting to sell the Bitcoin that was held on Mt. Gox. And there's something like $8 billion worth of Bitcoin, give or take when the price moves, the value of that Bitcoin changes. And also the German government has seized hundreds of millions of dollars worth of Bitcoin. And they decided basically on 4th of July, on a day when US traders are not at their desks. So if you're at a hedge fund, you're not, and you're trading cryptocurrencies, you're trading stocks, you're not aware of what's happening in the markets. The Germans just decided just to sell everything in the open market. And that caused the price to basically cascade lower. And as it did, leveraged traders, people who had borrowed to buy more cryptocurrencies, got liquidated. And what we saw, and I want to share this graphic, you had the most amount of liquidations in a single day since the collapse of FTX. Typically, when you see lots of liquidations like that, it's a sign of a bottom. And I also believe that the setup we have going us right now, right? We've liquidated a lot of over-leveraged traders. The price has pulled back, as it does in every bull cycle. It's pulled back multiple times. We also have a macro note from Bank of America, which shows that in June was the first month in 4 years that no central bank was raising rates. So we're now going into a cycle of global liquidity easing, which means that countries around the world, central banks, are going to start producing more credit and more dollars because the rates are going to be less restrictive. When that happens and there's more dollars around chasing things, you get better economic growth, and you also get more dollars chasing fixed amount of goods, of which Bitcoin is a fixed, finite amount of Bitcoin in the world. And I believe that will cause the price to start rising again. This is going to happen probably slowly, and then quickly as we get towards year end. I still think Bitcoin is headed to $150,000 to $200,000 this cycle. And the other thing too is that we thought on July 2nd that we'd have the Ethereum ETF. What I'm hearing from sources is that it's been delayed until this week. So we're probably going to get the Ethereum ETF approval. And like I said, I do not think the value of that is priced into Ethereum because it didn't rally into it just like Bitcoin did. And so I think that's also going to spark another Ethereum rally. In terms of strategic fortunes, I'm looking into a new blue chip crypto asset to add to the portfolio, especially on this weakness. And that'll be something that's coming out in the next 3 to 4 weeks. So keep an eye out for that.
That sounds exciting. Looking forward to that. Well, everyone, Ian, thank you everyone for tuning in this week. We appreciate you very much. If you do have a question that you'd like to share in our Market Insights mailbag, please email us at marketinsights@bannionhill.com.
Awesome. Thanks, Amber. Thanks everyone for tuning in. Have a great week.
You too. Bye.